Welcome to the WOW podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Almasri. Austin Yeh is a mortgage agent at Vine Group and a seasoned real estate investor. He started with $40,000 in savings in late 2018 and expanded his real estate portfolio to over 25 properties within 5 years. He also founded the Rise Network and co-hosts the Rise Real Estate Investing podcast. On this episode, we discussed how he was able to grow his portfolio really quickly, how being featured in a Toronto Life article changed his life, why he got into the wholesaling business, and how being over-leveraged on a sixplex, the complications and the stress that it caused, and the lessons he learned from that whole situation. And then also at the end, we touched a little bit on credit card points hacking. So how he's able to use his credit cards to go on vacations all over the place, send his family on vacations. I think you guys are truly going to enjoy this episode with Austin. If you do, make sure to leave us a review. It'll really help us grow, pass on this message to other people. So if you have a friend or family member that you think will enjoy the content, then please do share it. And finally, we are interested in helping you guys get into some small commercial multifamily. So if you're looking to buy an apartment building this year, I'd love to connect with you. Go to my Instagram page. My profile is WellOffX on Instagram again, and make sure to send me a message there. Tell me about what you're looking to do, and I'll be more than happy to share how we can help you get your first apartment building or your second or third or whatever the case might be. So there you go. Enjoy the episode. All right, I'm here with Austin Yeh. We've had a couple conversations in the past. We've been kind of trying to pin down a time, but obviously we've both been busy and it just never worked out, but I'm glad to have you here for the first time.
Excited to be here. Glad we were able to make things work.
Do you just want to tell me a little bit about your childhood, where you grew up, a couple things you remember?
Yeah, absolutely. So going back in childhood, my parents, I always like to start back with sort of the parent story because it leads into mine. So my parents were born and raised in India. A lot of people wouldn't believe me by looking at me because I'm Chinese. Dad dropped out of school at an early age to support the family, like the typical sort of immigrant story, right? And then they immigrated to Canada and had my sister and I. They actually met in Canada. And growing up, they're working multiple jobs, minimum wage jobs, to make ends meet. And so frugality was actually a big part of my childhood, right? Because my parents would use coupons to go shopping, would do fun activities, but it didn't really break the bank. And so growing up, all of the money that I was getting from like Chinese New Year, Christmas, birthday money, et cetera, were just being saved away in my bank account. And I didn't really spend it too much. So going into, high school, leading up towards that, I always sort of wanted to be a doctor or dentist because we didn't come from money and I wanted to make a lot of it. And so obviously going to the medical field was something that was top of mind, but never really had a passion in it. And instead I took my first business course in high school and really just fell in love with it and sort of went down that path from there. And then leading into university, I know you're asking about childhood, but just quick synopsis. I mean, leading into university here, I was like doing these internships, like I was working in consulting and audit. And I got a nice scholarship as well. And I was saving a ton of money, but throughout this entire process, I wasn't very content with where I was, even though like throughout my childhood, everyone told me you got to get good grades, get a scholarship if you can, go to a good school, work a great job, get a full-time job, and your life is set. And like I was going through the path of that. And like when I graduated and started working my full-time job, I was like, I'm not where I imagined life would be at this age. I'm not very happy with what I was doing, and I couldn't see myself doing that for the rest of my life. But that is me in a nutshell.
Okay, cool. Interesting about being born in India. Again, I wouldn't have guessed that. Is that something that's common? Like, I'm assuming that you have kind of an Asian background, and your family at some point went to India. Is that what happened?
Yeah, so I was born in Canada. My mom and dad were born in India. They actually didn't meet until they came to Canada, surprisingly enough. Yeah, so there's a Chinatown in India, in Calcutta, and a lot of Chinese people have grown around there. In fact, actually, funny enough, you mention it, like all of those who know, who live in Toronto, like they know these Hakka restaurants like Frederick's, Lynn Garden, et cetera, et cetera. My dad knows a lot of the owners because they all grew up in India together around the same area. So it's a small community.
Cool. All right. So do your parents speak like different multiple languages? Is again, this is not real estate related, but just curious.
Right. Yeah, no. So my dad is like broken English. My mom speaks like six
Awesome.
languages. She speaks, yeah, like a ton.
Cool. All right, so let's dive into your journey as a real estate investor. Obviously, for the people that know you, it seems like you've built quite a large portfolio in a short period of time. How did you manage to start? What year was it, and where did you go? Where
Right.
did you begin?
Yeah, so I started off like going into my first property. It was 2018, late 2018. I believe I closed in November or December 2018. So prior to that, I was working my full-time job, didn't want to do it for the rest of my life, so was trying to figure out a way to generate some sort of additional income stream, and rental properties is a great way to do so. So I started off actually investing in stocks, and that didn't go well. Did some research, read Rich Dad Poor Dad, ran across investing in properties. Had about $45,000 saved, roughly around that amount. And obviously, being in Toronto, that can't afford you much of anything here. So I ended up looking at different markets I could afford. And one of the only major markets as in like population size above 150,000, was Windsor, Ontario at that point in time. And so I ended up just calling a random listing agent for a property I saw. Don't recommend it. I recommend you work with an investor-oriented realtor, but I was just like sort of going with the motions. And she said her property sold, so why don't I just come down in Windsor and she'll show me other ones? So that exact same, so I called her on a weekday, went on that weekend. She showed me like 4 or 5 properties. And at the end of it, she's like, all right, which one do you want to put an offer on? Again, like I was like, okay, I guess this is how it works. So I'll put the offer on the cheapest property because that's the only one I could afford. So it was a single family house at $130,000. And it was sort of like, you know how a lot of people go through analysis paralysis? I was complete opposite. I was jumping in feet first, maybe too deep into it at that time, but got that offer accepted, got the inspection, waived the inspection condition. And then I was like, all right, now I'm stuck with this property. I got to figure out what I need to do from now on. And so I found out, and this is a tip for people, right? A lot of people are just like, oh, how do you get acquainted with people in a specific city? I went on Facebook and I was searching like Windsor meetup groups. I was just like, oh, Windsor real estate or meetup.com. You can go on meetup.com as well and just search like Oshawa real estate, whatever city it is. And I found out about a Windsor real estate meetup group, ended up attending there, connecting with like so many great investors. And that's where I got introduced to my contractor. That's where I got introduced to an investor-oriented realtor, which I'd use in the future. And I just started really spending that time building connections and a power team around there, and then executing from that first strategy. And I know you were asking about scaling the portfolio. During that time, I was just recording everything on social media. So I was recording the ups, the downs, the events I was going to, and people were seeing the pace that I was taking action, the pace that I was learning at. And so they're curious about following along. And eventually, through building that platform out on social media, and organizing my own meetup events as well, started off small and then grew bigger from there. I started raising capital. People just started reaching out and saying, hey, I love what you're doing. I want to be involved. And that's really how I was able to scale to the next level by partnering with others.
Was it complete strangers that you were partnering with, like people who just saw your stuff online, or was it people that knew you, or maybe they had met you at some point and they had been following you and you kind of just developed a relationship from there?
Right. I mean, there's 2 ways to go about it, right? Obviously, working with your inner circle is always recommended. But unfortunately for me, my inner circle was I just graduated school. Everyone has school debt. They have no money to give to me, right? Parents are blue collar, not really well connected. So the family side as well, it would be pretty difficult to raise capital there. So I almost had to step out of my inner circle and just connect with other people. And that was, the meetup didn't really start like I was organizing a meetup, Rise Network. It didn't really start as a way to raise capital. It was just like connecting with other younger people who are investing in real estate in the GTA and investing long distance. So people started attending these events. And to answer your question, I've had conversations with them through these sort of events that I was attending and events that I was organizing. And from there, we sort of built a trust. And that's how I was able to start raising capital. And then got to the point where People just reached out to me on Instagram. We jumped on a couple of Zoom calls, got a feel for each other, and it just grew organically from there.
Yeah, I think that's an important thing to note, because some people might hear this and think, oh, if I just post some videos online on whatever platform they're on, then people are going to want to partner with me. But it doesn't necessarily work that way. Like, you had that meetup group, you were face to face with a lot of people, they got to know you, they got to see you, and then they also see you on social media. So all of that together builds that trust, and it leads to potentially partnership.
Exactly. Yeah. And that was, I should have mentioned timeline wise, that was probably a year after I got started before I raised my first capital partner. And that wasn't taking things passively. That was attending every event, organizing events. That was going balls to the wall and building my credibility. Right. So no, that you're exactly right. People take one of these raising capital courses, start doing these small things and think in 3 or 4 months they're going to get their first partner. But that is definitely not the truth. Especially in today's market environment, it is a little bit more challenging in finding partners.
So how did you build the Rise Network? Like, I think I saw that you've got over 7,000 members there.
Right.
So how were you able to do that? Is that through meetup.com? Like, is that where everything started? And how consistent were you? Did you do it on your own? Did you have help from someone?
Yeah. So initially starting off, it was just more so, again, like I was investing in Windsor. A lot of my connections and friends were in London, like a lot of the real estate investors. So I was attending. Your audience probably knows Matt McKeever. I don't think he does investing anymore, but at that time he was all over on social media. So I was attending a lot of events in southwestern Ontario. And they didn't really have similar events in Toronto. The main ones are obviously like Rain and some of these bigger organizations, but I felt intimidated being a new investor and being very young. And so I just wanted to start my own little meetup where it's targeting towards a younger demographic. And at first it was just a Facebook group. And then people were commenting back and forth there. I threw a couple of updates about like my projects and I said, hey, why don't we just meet up together? And the first meetup, we actually surprisingly got like 15 or 20 people to show up. The second meetup, it was like 2 or 3 people. It was like going sporadically up and down. But over time, it was just like the value add. Like I was hosting these meetups completely free without an expectation of anything. And I was trying to just add value and create connections. And over time, the group started to grow bigger and bigger and bigger. And then I got featured on the Toronto Life article about, like, my story was featured on there. And then the group honestly just like blew up from there. And everything was word of mouth. So like realtors started inviting their clients started inviting their friends, and it just went from there. But it didn't, like, to be honest with you, it didn't start with building something grand. It started with like, there's a need here. It's not available in the market. I'm just going to do it myself and just see where it goes. And it just took a life on its own from there.
How did you get featured in the lifestyle, whatever that magazine was, the Toronto Life article, out of curiosity?
Okay. Yeah, that's a good question. A lot of it is, so at that time, I was documenting everything on social media, growing my portfolio, and I was really big on branding. And I was trying to figure out what's the next way to take my brand to the next level, and build my audience. And so I decided to cold reach out to every single news article that I could. So Toronto Star, Toronto Life, Globe and Mail. I had a quick synopsis. It was like 2 paragraphs saying, hi, my name's Austin. This is what I've done. I would love to be featured on your news article if this is something you think your audience would get value out of. It was just like literally finding editors. So I would go on Toronto Life website, for example, and you can look at like certain categories and see who the author or editor is. And then you can click on it, find their information either on LinkedIn, sometimes it's on the site, and just email them, right? So it's a lot of digging and creating an Excel list. And then actually 2 news articles reached out to me. So it's Toronto Life and Toronto Star. Then the pandemic hit, and then they didn't decide. Both wanted to publish my article. Both didn't publish my article because the pandemic hit. And then I followed up with them 7 months later after the pandemic was going on. I was like, hey, still interested? And Toronto Life was still interested. Toronto Star was not. They still wanted to post pandemic news. But it's just, I mean, people like to think that you have to have these connections. You really don't. Like, it's just about grinding and just like throwing things out there and seeing what sticks.
That's cool. I've never actually heard someone explain how they were featured, but that's good to know that you basically hustled to get on there. Like you said, it wasn't a connection. You didn't know someone that worked there. You just created the opportunity yourself.
Right. I don't think there's a ton of people who are actually taking the step to do things like that because it is quite time consuming. But nowadays, you can get your virtual assistant to
Yeah.
help with all of that, right? So you can be a little bit less hands
Has
off.
there been any sort of negative repercussions of doing that? Because you know how sometimes when people are landlords are in the news, they're looked at a certain way. You might have people that you know tenants or whatnot that might look at you as a villain. Has anything like that ever happened?
Yeah, of course. So definitely the reaction was split 50-50. Even before publishing an article, the editor gave me 2 or 3 days heads up. It's like, hey, look, like you can pull out of this if you'd like, but just to let you know, you're probably gonna get a lot of hate. So there's a lot of death threats. My article was shared in the tenant
Mm.
group. I guess like tenants have their own group, and then they were just people were talking about it. It was on Reddit. It was on like all of these different websites of people just like dragging my name. But that being said, I mean, that's the least of my problems, right? In real estate investing, you deal with so many more bigger problems that's going to cost you money. People will hang on to something for a week and then they'll find something else to move on to talk about, right? Whereas the people that have impacted, so actually the net positive was much bigger than the net negative. The pushback was a week or two simmered out. The net positive of the impact, the people that I reached were significant. They started following me on Instagram. They joined the Rise community. A lot of them I'm still in touch with today. Like when I organize these events, sometimes people will come up to me and say, "Hey, I read your article. That's how I got started in investing." So, that being said, that was a little bit different before. Today, I think the pushback will be even more significant because almost every news article is about real estate
Mm-hmm.
investors and the housing crisis, et cetera, et cetera. So I don't know how it would play out in today's market. Probably
Yeah,
not
well,
as
I'm
good.
also thinking like if you continue to grow your portfolio and I don't know, let's just say all of a sudden you have 300 units or something and the people that are living in your properties start to recognize that you're that person that was in the article. I'm not sure if that would
Right.
lead to any issues or cuz I've had a lot of tenants actually Google me and they tell me, "Oh,
Yeah.
I didn't realize you had so many properties, or you were featured on this or
Yeah.
that." And like they have all this information about me. So at times I feel like it's better to just fly under the radar and not be out there. But anyway, everyone has their own opinion on that.
I do agree with that, right? Like that was definitely a big worry of mine, whether it would sort of catch flame and people would find out about me being the landlord, etc. But fortunately, I guess most of the leases. So again, a lot of my growth was with joint venture partners. So a lot of the leases are not under
Mm-hmm.
my name. So these tenants don't even know who I am for the most part. And if I believe you have a couple multis as well. I assume it's under a
Yeah.
corp, right? Like it's hard to always trace back. So I mean, yeah, you're right. Like, if you're a mom and pop landlord and you're going out there, there is the real risk that they'll find out and they could be bitter and I don't know, stop paying rent or
Yeah.
I don't. Maybe their relationship might
Well,
change.
with that said, I know we're jumping ahead. Like we'll dive into your growth as well, very shortly. But just on that note of having your properties in a corp, which I do, but I like to be pretty involved in the properties. Like I'll go on site when we take over a building or something. I'll kind
Right.
of introduce myself and um, I want people to know that I'm going to be active in this. I'm not just going to like lay back and do nothing about the issues in the building, that sort of thing. Do you do that as
Yeah.
well, or are you more trying to delegate everything so that your name's not really attached to the property?
Good question. I mean, the day-to-day management, property manager
Mm-hmm.
handles it for the most part. But when there's these high-value tasks of like non-payment of rent or something significant has gone on, and I feel like I need to involve myself, then I do get involved. I don't typically speaking in most situations. I don't introduce myself as the owner. I introduce myself as the property manager or an asset manager for the
Mm-hmm.
corporation. So I manage the assets of the corporation, but we have a day-to-day property manager that will help them out. In some cases, I do introduce myself as the owner. But when I do make that introduction as the owner, I like to play a little bit of good cop, bad cop. So I'm the good owner, and then there's another owner that is a
Oh yeah,
little
yeah.
bit less empathetic, right? So I say, hey, I'm part owner of this property, right? We have a couple of owners together. My name's Austin, da 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 da. And like to your point, like I want to be involved, I want to help you out, whatever, whatever, whatever. And when they come to me with something that I don't agree with, right, I might say, let me speak to my
Mm-hmm.
partners and let me get back
Yeah.
to you, right? Even if there's no partners involved. So I just don't want to be the
Yeah.
decision maker. Otherwise, if you're the decision maker, you're the
Exactly.
enemy in their
Exactly. I
eyes.
agree with that. I think that's really smart to do. And I also do that when it comes to like evictions and stuff. If they ask me a question like, "Hey,
Yeah.
can we extend this? I need a little bit more time." I try to say, I'll connect you with the paralegal. The paralegal is going to represent me on this, so that again, it's not me who's the enemy, like you said, because that's the last thing you want. You don't want to be creating all these problems with people, right? Yeah,
Yeah. Exactly, because the buck stops with you. If you're the only owner, it's like, oh, I gotta ask whatever. No, you don't gotta ask anyone because
yeah,
you're the owner. You make the decision, and you don't want to get put in that
yeah,
position.
exactly. All right, so let's continue. So 2019, that article gets released. Your group starts growing. You have the Rise Network. Your members are growing there. You're starting to create these joint venture partnerships. What did you start
Right.
going after? What types of properties are you still going after? Single family homes in
Yeah.
Windsor, or
Yeah. So after I did 2 single family homes in Windsor, then duplex, and then a couple duplexes, a conversion, triplexes, and fourplexes, and then like student rental. So I was like dabbling around wherever I could run across good opportunities. So I was continuing to scale that way. A lot of it's smaller multifamilies, nothing like really major at that point. The article came out actually during 2020. The Rise Network group got a little bit bigger. And then at that point in time, there were deals that I was getting on my plate, right? But from either realtors, they're like pocket listings, or just like investors knew me around the area because I was always going back and forth. And so they would slide me off market deals of opportunities that they ran across. And that being said, while these opportunities fell on my plate, I wasn't able to take advantage of all of them because either I wasn't able to raise the capital fast enough, or the project didn't really fit my criteria. Still a good deal, right? So I started wholesaling some of these deals by accident. Just like I knew what wholesaling was. The intent was never to really wholesale, but I did a couple of small wholesales, like a small 2,000 fee here, $5,000 fee here, and then I did I think a 15 or 20K assignment fee as well. And I was like, wow, like this is a pretty good business model. I've been trying to build a portfolio for me to eventually leave my full-time job. Because keep in mind, I'm still in corporate during this entire time. So like the real estate stuff is part-time. And I was like, building a portfolio of cash flowing properties is going to take a lot longer than what I originally anticipated, right? As I became a landlord, I realized in Windsor, we're buying these 100-year-old houses. Yes, I can make it look pretty, but in a year from now, maybe something leaks because the plumbing is 100
yeah,
years old,
yeah,
right? So it's like the money just ends up getting reinvested in these properties. So it wasn't what I imagined. So I realized I needed something active. Wholesaling was there. And then one of my buddies, Waylon McGill, who I co-own Fast Ontario Home Buyer, but Pete, your audience probably knows it as Ontario Property Deals. That's our wholesaling company. Waylon was starting up wholesaling, and he was he's pretty high up sort of executive leadership role in tech sales. So sales is what he lives and breathes. And I'm not a great salesman at that point. So, but I have the real estate knowledge and the investor connection. So we decided to partner together and sort of build that business out. And that became the main active income stream. And a lot of these, like the audience from Rise, a lot of them started shifting over to be some of our buyers for our wholesale deals. So we're able to quickly grow a buyers list because I already had this community here. As well as we were scraping emails off of Facebook and like doing some other stuff to help build and nurture that list. And then once we started getting a couple of deals going there, I decided to leave my corporate job and then just focus fully on wholesaling as my full-time income.
What was your corporate job, by the way?
Yeah, I was in commercial banking at one of the big
Oh,
five
okay,
banks.
okay. All right. So, what year did you finally leave your corporate job?
Yeah, so that was my last day. I should remember my last time. It was February
Okay.
2021 though. Was when I
All
officially
right.
left.
All right. And
Yeah.
then, so if active income is coming from wholesaling, I know I'm on your list. I receive your opportunities. So that becomes your main thing. You're building your portfolio on the side. Still at that
Right.
point, I'm assuming you're going after, smaller multis like triplexes, fourplexes, that sort of thing. At that point, did you see your cash flow start to increase, or are you still just kind of breaking even? You got to repair this and that here and there.
Right.
And what did your goals become at that point with your real estate investing?
Yeah, the asset acquisition ended up becoming more so as a long-term wealth builder. And yes, like the assets did cash flow, but not being boots on the ground in Windsor sometimes did make things difficult, especially on the student rental end, because students tend to turn over every year, every 2 years, whatever the case is, right? So if you have a month or two of vacancy and you refi the property at a high ARV, your carrying cost is pretty significant, right? So 2 months of vacancy could erode a decent amount of cash flow. So that being said, it was cash flow positive, the portfolio, but I could never safely rely on it because there's always money coming in and then money being reinvested around. So back into the properties. So my goal on the investing side was continue to acquire, right? But maybe not as a rapid pace as when I began, because there was a point in my real estate journey where I was growing aggressively, and then the pandemic hit. I had 3 closings to go through, and obviously prices were falling off a cliff. Raising money suddenly became very difficult. The properties didn't officially close until like after, I think it was like May. And so some partners were like, I was interested, not interested anymore because of what's going on. And so I found myself having to pull from a lot of line of credits to get these closings over the edge. And it was a very scary time because I was still in my growth stage. And those who joined Durham REI, like Quentin always says, the growth stage, you always sort of, there's a lot of debt involved in the growth stage, and capital tends to flow out. And so I was at that point where, man, if anything was to shake out and property prices were to fall more and more, I would probably end up defaulting on a couple of mortgages because of the scale I was growing at, right? That was a scary moment for me, which is why after that, like, property prices ended up ripping. So it was a good learning lesson not to do that again. So I was saved by the market, refied a lot of the money out, which was great, and then started to grow my portfolio in a responsible way. It's not a race. It's not 100%. A race at all, although people treat it as a
Some
race.
people, yeah, for sure. A lot of people have gotten in trouble. We're seeing it now because they were growing too fast. First of all, are you still a member of Durham REI, just out of curiosity?
I've actually moved to Midtown to Toronto, so the traffic's a disaster. I try my best to make it out when I can, but it's like one of my favorite meetups in Ontario for sure.
Okay. Did you continue to buy smaller multis, or at some point did you change your strategy? Did you go to Airbnbs? Did you go to larger multis?
Right.
Where did you go from there?
I did a little bit of everything. So I did an 8-plex, I did a 6-plex. I did do a little bit of Airbnb. Like the main core focus was definitely on the wholesaling side. Okay. But I would, again, still acquire when I could. So I'll give a story with, the 6 unit that I bought in Northern Ontario. So we bought this property. This was a wholesale deal that we sent out, didn't get the price that we were looking for. So we decided to close it by ourselves. And we got financing from a credit union. It was like 52 or 53% loan to value because the rents were very low, and we had to raise the rest, right? So this is sort of a learning lesson here. We levered up pretty aggressively. At that point in time, it was very easy to raise money, right? So we bought it for 505. It appraised at 625, but to be frank, I don't care about asset value. I care about what the rental yield is, right? But the asset value appraised higher. So I guess hoorah. And then using that appraisal value, it made things easier to raise capital. So it was able to go fully levered on the property and raise money for promissory notes. Your audience should be like cringing right now about like with what I'm saying.
So just in case somebody's a little bit lost, it sounds like you basically got 100% loan to value through the credit union, and I don't know how else. Private money. And then on top of that, you got additional funds through prom notes for renovations, I guess.
Yes, prom notes.
Promissory notes. So and then one more thing, just to clarify for anyone listening that doesn't know what a promissory note is, it's basically it's funds that are borrowed that are not registered against the property. So if you default on the loan, you can't use the property as collateral if you're lending that money.
Right. Yeah. So obviously a very high risk loan. At that point, promissory notes were flying left, right, and center. Very easy to raise, right? So this was 2021. And the property was fully tenanted. So keep that in mind. That's why my loan amount from the credit union was very low. And obviously it was a lot of pressure because it was like it's a race against the clock. Fortunately, I was able, like, I'm pretty efficient in having conversations with tenants, working out cash for keys agreements. Was able to, one of the tenants left on their own, had conversations with 5 others, and then was able to work out a cash for keys arrangement. And then eventually it became vacant. So I was able to execute the strategy, right? Refinance, I think, all of the money out, if not maybe a little bit more, something along those lines. The refi was very strong, and then pay back all the lenders. So happy story at the end of the day, but throughout that process it was miserable. It was like, okay, like, what if this person changes their mind and doesn't leave enough to go to the LTB? My prom note is a year long. The LTB wait time's a year. This is like, how is this going to shake out? So this is like, I guess I made it out the trenches there, and it worked out for the best, because really I got an asset where I didn't have to put any money into it. But that being said, I never replicated that again, right? It went well, but I never replicated it again, because it is a very stressful period. And I'm of the understanding, if a tenant didn't leave, if things didn't pan out, then I would be stuck holding an asset that's cash flow negative, and I really had no exit strategy to pay everyone back.
It's a very risky thing to go through, and then, like you said, the stress that you put yourself through during that time, because you're probably just constantly thinking about solutions and problems and what can come up, and that just eats at you. So I totally understand that that's not a place you want to be constantly in your life.
Right, exactly. And honestly, that's what makes multifamily so tough now, is that when you buy a property fully inherited, really you are sort of taking that chance, right? Unless you're raising equity partners and you guys are all on the same page and you have a 5-year time horizon. But if you're trying to do a multifamily solo, and let's say that you're raising a ton of private, it is definitely a little bit nerve-wracking, because, like, turning around tenants with rents at what they are right now, a lot of them probably cannot feasibly find a place that is similar to what they're renting at the moment. So that transition's a lot harder. Cash for keys becomes a lot more expensive, or tenants will flat out reject it. Even if you give them 15 or 20K, they'll say, no, well, we like what we have. So, but anyways, when the rate started increasing, there was a lot less interest in multifamily properties, even single family homes for that matter. Like, things almost halted when the Bank of Canada started.
Are you talking about
and I saw that
wholesaling business? Is that what you mean?
Oh, well, I guess both. Yeah, sorry. I was going to get into the acquisition side, but on the wholesaling as well, buyers freaked out. And I don't blame them. Even I was a little bit worried, because it's like, what's happening? This was also new, and the pace of the rate hikes were pretty aggressive, right? Like, inflation was what is it, 8 or 9% at that time? So it was like, what the hell is going on right now? But that being said, the wholesaling was starting to slow down. There was appetite for single family flips, definitely not as much for multifamily, definitely not as much for BRRRRs, where people wanted their money out pretty quickly. That's halted. But that being said, I saw that as an opportunity to get back in the market and buy some assets without having to compete with people, and put some pretty aggressive conditions. So from the period of October, it was either September or October 2022 to December 2022. And keep in mind, I would argue this is close to peak fear, because at that point, rates were hiking pretty aggressively, and there were no buyers in the market during that time. It was silent. And I was throwing out offers there below asking with very aggressive conditions. One of them was vacant possession on a triplex, and I got it. And it was fully tenanted, got vacant possession on that triplex. And then the inspection report came back with some like minor things that needed to be fixed. I said, I'm not like, this has to be turnkey. I was like, you got to fix all of this, and I need to approve these fixes, right? If I don't approve these fixes, I'm not closing on the property. The seller ended up accepting that. So, and that became a full BRRRR. And then another property was, I'm trying to think, what was it? Another one was a 4-unit, I believe 1 unit. Yeah, so this one, like, 1 unit was vacant. 1 unit was just about to be vacant. It was listed on the market for a while. And then I only knew 1 unit was just about to be vacant as well, because I just made that phone call and said, hey, like, tell me about what's going on in this property. And then so there were really 2 units that I had to negotiate with. And I put in a condition in there that says, This offer is conditional on me negotiating vacancies. In the case I'm not able to secure the vacancy negotiations with these tenants, I will refuse to close on that
Yeah.
property. They accepted the offer. Was able to negotiate it vacant possession, and then I flipped it like in 2 months. So I bought it vacant, flipped it at 100K more, but like the net profit was like 50 or 60,000 because I have to pay cash for keys, closing costs, and like all of that. But that was like a 2 month timeline. I was just throwing out like aggressive offers and just trying to get deals
You know
done.
what's interesting about that? So I had a property. This was a few years ago. It was a condo in Mississauga. So originally it was an apartment building, and then the owners flipped it to a condo with multiple units that they were selling individually. But as part of this process, the existing or some of the existing tenants, they had the right to remain basically a lifetime in that unit. Yeah.
Really?
So even if the purchaser of that condo unit wanted to move in, they would not be able to, because the way the condo board and whatever was written, this tenant had that specific right. So
Right.
the units that were tenanted were selling for like 200K, 300K less than the ones that were vacant. And there was this one tenant we walked through and we were just chatting with them and seeing like, can we negotiate with them? And they were asking for like 50K or something to leave. But then as part of this process, we had a conversation with the lawyer and said, hey, can we do this before we close and negotiate? And basically they said, you're not the owner. You can't negotiate with them. They could take your money and technically refuse to leave, and they would probably have the right to remain in the property. So that was an extremely kind of high risk thing for us. And we just decided to walk away.
That's a good point that you mentioned there. Technically, not being the owner does put you at risk, right? Which is why in the condition, I also put in that the owner is aware of the negotiation. They have to legally sign off on the N11. I'm not signing the N11 because I'm not the owner yet. I'm negotiating it. The owner has to sign the N11 and then the L3, if I'm not mistaken, that's like the form after the N11 when you put it towards the LTB. The owner has to sign off on the LTB as well. On the LTB form, the L3, they have to fill in the declaration, etc. So I'm making sure that the owner, like in the condition I specified, they have to fully cooperate with any reasonable request of signing the documentation. So they are basically the one that has filed everything, right? But you're right, there's still a risk because if that tenant doesn't leave, that owner can just like maybe someone needs to confirm with the paralegal, but I imagine that owner could just flop on the hearing date. They might be like, oh, like I saw the property's closed.
Yeah,
whatever.
exactly.
I'm not like forget the hearing date, right? So there's risk.
It would get significantly more complicated because you can probably write the agreement where basically you don't close until you have the vacant possession, and then you would need the owner's cooperation, like you said, to get you to that point. So that's what's beautiful about real estate. There's so many creative ways to make money in it. And if you find these opportunities, like so many people are going to walk away because they see a challenge there. But if you can figure out a way to come up with a win-win solution, then you can make a lot of money.
Absolutely. And when things are slow, you can cap your downside risk while creating these creative solutions, right? Because sometimes even in a hot market, you can think of creative solutions. Like they'll be like, oh, like I want a vendor take back, but I still need to go clean on the property, like no conditions because there's so much competition. But in a time when there's no competition, like you can think about what's the downside risk, like write a condition about it. You can write a condition really about anything. You can be as creative as you want, right? So you're absolutely right. Like it's all solutions driven, and in a slow market, I mean, there could be a ton of problems with the property, but you can just write a million conditions in that offer.
Yeah, exactly. Cool. I like the way you've done that. I wanted to ask you about your podcast. So the Real Estate Investing Podcast, Rise. I see in my notes that you have over 285,000 downloads. How did that happen? Because I think you started like not that long ago, from what I remember. I know it's been maybe 2-3 years, I would assume, but how did you grow it?
It's probably around
how did you grow it that quickly?
I think a lot of it was the community building on the Rise Network side, right? I will say a big part of it definitely is going to be the article, the Toronto Life. Like that got me some insane exposure. So it's not, I mean, that is like, I don't think that someone can replicate that really. It was just the exposure that got a bigger audience to tune in. But also just like the Rise Network Facebook page, right? Because they go hand in hand with each other. So as more people get added to our Facebook group just through word of mouth. More people learn about our podcast and just start tuning in. But when we got started off, the first few episodes was like, I think like 20 downloads, 30 downloads, 10 downloads. And after a while, again, like it just being consistent, it just started growing from there. What we've been trying to do now is, and would love to have you on the podcast as well, by the way, but we've been trying to reach out. We've been trying to collaborate with like other sort of influencers in the real estate space who are not necessarily within a sphere of influence. For example, we had Tom Story on our podcast. If you guys go on YouTube and search Tom Story, he's a pretty big YouTuber, mainly focuses on the condo side of things, if I'm not mistaken. We've had him because with him resharing with his audience is going to bring more listeners to us. We had TK Butler and we had Daryl Frankfurt of the Canadian Real Estate Show. So they operate pretty cool podcast as well. Their audience is very niched and much different compared to our audience. So having them on again, having them reshare it brings listeners to our podcast. So we've been just trying to figure out interesting collaborations.
Cool. Well, that's an amazing result to have that many downloads, and yeah, I mean it's great that you were able to build it up to that point. Are you monetizing it just out of curiosity, or is it not something you've really thought about right now?
We've had sponsors definitely approach us. I think we're just sort of waiting for the right moment, because that podcast is ultimately going to be a lead funnel. So I'm in the mortgage business, right? My partner on the podcast, the co-host, is on the mortgage business as well. And so we want to treat that as a lead funnel. So keep everything free. At the moment, maybe things will change, right? So I just don't want to say yes or no. But right now, it's a loss leader. It's like a marketing cost for us. We spend money on the VAs operating it and all of that, but we're going to make it back in the business that we generate from it.
Awesome. All right. And last thing that I wanted to touch on, credit cards, points hacking. Tell me a little bit about that. You seem like you have some knowledge on it.
Right. Yeah. By far, I'm not an expert in this topic, but I do know a thing or two around it. So in real estate investing, a lot of people get into it to build a lifestyle that they sort of dream of, right? Whether that be like accumulate wealth over the long term, financial freedom, maybe travel the world, passive income. There's a way for investors to sort of have that travel lifestyle now if they're investors. So real estate investors have a big spend just organically, right? They buy a ton of materials from like Home Depot, like kitchen materials, et cetera, et cetera. And it's like, why not take that spend and be able to generate points to travel with it? So what I usually do is I rotate between, it's called credit card churning. CHURNING, not turning. So your audience can search that out. But basically, like one of the easiest ways to get started is to get credit cards that have bonus Aeroplan points. So if you spend $5,000, you'll get $40,000 or $50,000 in Aeroplan points. So get a card, hit that minimum spend, plan it out with your renovation, get those points, and then get another card, right? And just recycle that way. And your business can do the same. So I had an Amex Platinum on my personal side. I also had an Amex Platinum on my business. And I recently got an Amex Platinum, my business as in my holdco. And I recently gotten an Amex Platinum for the wholesaling company. So that's 3 Amex Platinums. That's like 90,000 each in terms of points. And a one-way flight, like if you, earning points is one aspect. You need to understand how to redeem the points to get the best flights, because some flights are more expensive than others. If you're good at the redemption, and there are people can hit me up if they're interested in learning more, but there are websites that help you monitor the redemption. Like I was able to book business class tickets from Toronto to Taiwan one way, and it was about 80,000 points. The retail price is about $8,000 for that one-way flight, right? And this is just by churning these credit cards. Then there's like the game goes deeper. Like if you spend, like people use the Amex Cobalt for like restaurants and stuff because it has good points multiplier. But I don't want to get too in depth, but that's just the high level, right? Like if you do a little bit of research, you can quickly pick up on it.
Now, when you have like you're churning your cards, let's say, are you using one card for all the properties, like different corporations, different joint ventures, all that? And you're, I don't know, figuring it out on the accounting end after, or how does that work?
Yeah. So I do a card property usually. So I'll get a specific credit card and load it up with expenses for a single property. But to be honest with you, yes, it is a little bit, it can be an accounting
Mhm.
nightmare. So you got to really make sure that you track everything very well on your expenses. Because there has been situations where for me to hit the credit card, to hit the credit card minimum spend requirement, I am loading like two properties into one
Mhm.
card. You just have to, again, like it's just really a tracking exercise. Definitely speak to a bookkeeper and accountant before doing it. I didn't, to be honest with you. I just tried my best to meticulously note everything as I was
Yeah.
spending it. But best practice is to speak with a
Yeah.
bookkeeper.
So you would have, let's say, like you just acquired a property. I'm just throwing out random things here. Let's say
Right.
RBC has a promo on a card that you like. So for that particular
Yeah.
property, you're going to go to RBC, open a checking account, apply for that credit card, and then just start using that card for all the expenses on that property. Or is your checking account with a different bank, let's say?
So I have checking accounts with every bank just because of my joint
Yeah.
ventureships, right? So that wasn't really a problem with me. But yes, if that's what it takes to get the card, I'll just go ahead and do
Okay.
that. But you got to be careful and monitor your credit as well. You just don't want to. For me, I went balls to the wall because I bought three properties within a pretty close period of
Hmm.
time. So I was like, all right, my credit's going to take a little bit of a bruising, but I want to make sure that every property's renovations, I get points from it, right? But it ends up recovering over time as well. So it wasn't the end of the world for me. But that being said, in the most ideal world, you do want to plan your expenses and not apply to 10 cards at once. Otherwise, that is going to have
Yeah.
a pretty
Yeah.
substantial impact on credit score.
Interesting. Yeah. I've never really looked at that at all. To me, it's just about having really clean accounting as much as possible. So
Yes.
I just feel like I don't want the headache. Although I'm definitely missing out on some rewards, and it does suck sometimes. But whatever. I'd rather personally just have a peace of mind that all my accounting's clean. I don't have to
Yeah.
also pay a bookkeeper extra just to clean everything up for me.
Yeah, I mean, there's ways to definitely go about it neater. You're right. I mean, if you get one card for one property, that's definitely a way to go about it. But if your property is already stabilized, you're not really going to hit the minimum
Hmm.
spend because a lot of the spend comes from a
Exactly.
renovation,
Yeah,
right?
that's true.
So, yeah, no, you're right. You're right. Like it could make accounting messy, but if you get a card and you commit yourself to just one property, that is a way to
Yeah,
go about
for
it.
sure.
And then you can close it down
Well,
after.
or for me, like I have a corporation that owns multiple properties, so I might use the one card associated to that corporation, and then just do account transfers just to make sure everything's clean. But that's kind of a story for another day. It's nice
Right.
to hear how you're able to use your point hacking to travel and get all that stuff done. It actually it makes me want to reconsider and see if I can make some adjustments on my end. Is there any?
By the way, I would definitely
Yeah,
recommend it. I sent my parents to an all expenses trip to Italy for Christmas just through collecting
awesome.
points, and that's like, like it can open up some pretty amazing
Yeah, that's really
opportunities.
cool. Um, any final thoughts? Anything you want to touch on that we may have missed?
No, man, I think no, this was fun. This
Yeah,
was fun. Let me think if I have any final thoughts. No, not really. I guess follow me on
yeah,
Instagram, Austin Yeh
yeah.
6. Uh, other than that, okay. I guess yeah. So actually, I do have some final thoughts on social media. And this is like sort of this is a little bit of a rant, right? Like investors use social media as a way, obviously, to build credibility and to help with their business. I know for a lot of consumers, including myself, like you can get obsessed with looking at what people are doing all the time and feel behind. Just realize that social media, and people probably say this, but it's true, it's people's highlight reel, right? Like the investor community is very small. We all go through the same sort of trials and tribulations. I know people who are out there, I just see their stories, they're raising money, and it's like, I know that you don't have money to pay back these lenders. Because I've loaned to, like, I maybe don't want to disclose too much, but you see things happening on social
Mhm.
media that are so disconnected from the truth. So if you're constantly going on there as a way to sort of compare yourself to others, don't
Mhm.
do that, right? Again, it's people's highlight reel. The truth isn't always on there. Take things at your own
Yeah,
pace. Right, take things at your own pace, be responsible, mitigate your risk, and just don't worry about what the next person
yeah.
is doing. And then you'll do fine over time.
100%. I agree with you. I've said the exact same things actually on other podcasts that I've been on when somebody's asked me that question. So no, I definitely 100%.
Mhm.
This was fun. I appreciate you sharing your story, your growth. Um, I'd love to be on your podcast too. So let me know if we can get that set up, and we'll have all your information in the show notes, and we'll be in touch.
Awesome. Appreciate it, man. Thank you.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.